The reverse repo facility really hasn't increased. In fact, it's shrunk in size since the events of March. So it's really not on net accounting for the decline in deposits. Really what's happening there is that market rates are higher than deposit rates, and depositors are moving their money. This happens in every cycle. I think I raised.
May I interrupt for just a moment,
please,
Mr. Chairman? So, are my numbers incorrect that we now have $2 trillion that are parked in this facility by money market?
We had $2.5 trillion before March, so it's come down in size. In fact, now the Treasury is refilling now that the debt ceiling is solved and they're refilling the Treasury General account, the reverse repo facility has been declining, and that's what we would have hoped to see, rather than taking reserves out of the system.
Since workers have had all three at once. No matter what goes wrong in the economy, whether it's a financial crisis or bank failures, whether it's supply chain turmoil or energy market disruption, working people always pay the price. Meanwhile, corporations always somehow find a way to increase their profits. They always find a way. Financial crisis, profits go up. Mass unemployment, profits go up. Global pandemic, profits go up. War in Europe, profits go up. Increasing energy costs, profits go up. When supply chains ground to a halt when Putin invaded Ukraine and the economy reopened and demand surged everywhere all at once, the rest of us saw problems to solve. But in many corporate boardrooms, executives instead saw an opportunity. For the largest multinational corporations, inflation has been a perfect excuse to increase profits by raising prices far beyond the costs of their inputs.
As you watch Vice Chair Barr roll out higher capital standards, it seems like your very clear statements is that you will be supporting as well as working to implement Vice Chair Barr's recommendations. But as you know, that the other members of the board, Governor Bowman has recently said that Mr. Barr wrote a report on Silicon Valley Bank's failure that provided his conclusions and went on to state that the report should be used to help guide discussions among policymakers, not necessarily just to rush towards implementation of Vice Chair Barr's recommendations. I'd love to hear your thoughts on that path forward, if in fact your job is to rubber stamp the decisions of Vice Chair Barr, or is your responsibility to take into consideration the Vice Chair's recommendations and then chart a path that seems to be consistent with what is in the best interest of our nation and, frankly, of our financial institutions. I do not believe that increasing significantly the capital standards is in the best interest of small businesses or people looking for loans. The more capital we put on the sidelines, the less capital there is for us to see our financial institutions loaning the money out. I look forward to continuing our discussion during the question and answer time.
Thanks, Mr. Scott. Today we'll hear from the Chair of the Federal Reserve, Jerome Powell, and monitor.
I'd like to raise with you, Mr. Chair. It's something that you identified nearly a decade ago. At that point in time, the Fed created a reverse repurchase facility that was intended to be a tool that would put a floor on interest rates. The facility was targeted at investment vehicles like money market funds, which actually play a significant role in the short-term funding markets. At that time, you joined others on the board in expressing concern about the possible unintended consequences of this facility, particularly in times of market stress. That's where this facility could actually exacerbate the so-called flight to safety. Since that time, this facility has grown to over $2 trillion worth of overnight deposits at the Fed. So I'd love for you to walk us through, if you might, the potential risks that this facility might pose, and take us through how it relates to basically pulling deposits out of the banking system at a time when we'd like to retain those deposits.
So the reverse repo facility really hasn't increased. In fact, it's shrunk in size since the events of March. So it's really not on net accounting for the decline in deposits. Really what's happening there is that market rates are higher than deposit rates, and depositors are moving their money. This happens in every cycle. I think I raised.
May I interrupt for just a moment,
please,
Mr. Chairman? So, are my numbers incorrect that we now have $2 trillion that are parked in this facility by money market?
We had $2.5 trillion before March, so it's come down in size. In fact, now the Treasury is refilling now that the debt ceiling is solved and they're refilling the Treasury General account, the reverse repo facility has been declining, and that's what we would have hoped to see, rather than taking reserves out of the system. We have quite an unusual situation in the labor market, where we've had persistently much higher demand for workers than the available supply of workers. So some of the process of getting demand and supply back into alignment has been taking place through declining job openings and through lower quits rates and through wages that are moving, that are still very high, but moving into more sustainable levels of increase. So actually there hasn't been a meaningful increase in unemployment. The unemployment rate has bounced around at historically low levels, and that's fine. That would be the perfect way for this to continue to happen. There's no guarantee that will happen. I would just say that it is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
And thank you. But in the dual mandate suggests that those workers, that obviously you look out for those jobs and those workers, but we also know that those workers are the first to be laid off. And I would hope that in your next meeting, the Fed recognizes those disparities and gives them real weight as you make decisions that will likely at some point result in more layoffs. Probably my last question. Since you last testified in front of this committee, we've had three of the largest bank failures in U.S. history. You explored that a bit at the end of your testimony, because the executives at those banks failed at Banking 101. Regulators took swift and decisive actions to protect the banking system and depositors. Thank you for that. That's in stark contrast to regulators' supervisory failures in the years before the 2008 financial crisis. What actions are you taking today to prevent more bank failures and to make sure banks do real risk management and address liquidity and other basic risks? And you may in part want to answer, I mean, he can do it himself, but Ranking Member Scott's comments on Vice Chair Barr and where that takes us. But what do you do to make sure banks do real risk management and address liquidity and other basic risks?
So I would say we are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other two failures, and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size. And I can go into more specifics in the course of the hearing, but I do think we need to learn those lessons, and I think we've started to do that. And it's something, what we saw was an unexpected bank failure overnight led to contagion and threatened the broader banking system, and that's not supposed to happen. And we're gonna take appropriate measures to reduce the chances that something like that would happen.
Let me follow up briefly on that. The Fed plans to propose an overhauls we've talked about to existing bank capital requirements, so we have a more resilient banking sector. Is increasing capital requirements for banks with $100 billion or more in assets to prevent future bank failures, is that a strategy the Fed plans to, is willing to deploy to promote financial stability?
So we have not come to there hasn't been a final proposal. There's been a draft proposal that's been circulated, but it's, in my understanding, it's not final, and I know things are still moving around a little bit, so I don't really have a final proposal that I can comment on. I do think that the capital increases that are getting so much notice are really on the larger banks. There may be also some capital increases in the proposal for banks down to $100 billion, but not below that.
And yesterday you said we want to, in particular the G-SIBs, the 8 largest banks, to have very high levels of capital and liquidity. You stand by that statement?
I did, and I said, of course, we did spend years raising capital and liquidity standards a great deal on those institutions, and I supported all of that. And then I concluded by saying that further increases, if they are proposed, will need to be justified. They'll, of course, as any change in rule would be.
Senator Scott.
That to the side, my last thought question for you is that SVB suffered because their bond portfolio ended up carrying water in a negative way. You have a $8 trillion balance sheet and beyond. Every report that I've read is that your bond portfolio, our bond portfolio, the Fed, is underwater as well. Can you talk to me about the losses that you're experiencing at the Fed from a bond perspective?
Remember that the way it works at the Fed is when we buy assets during QE, we pay for them with overnight interest rate reserves, And we've, for many, many years during the QE era, we've earned a spread, and we've been sending money to the Treasury way over $1 trillion since QE started. And so now that rates have gone back up to 5%, that process has reversed. And these are paper losses; they have absolutely no effect on our ability to conduct monetary policy or really on the economy. It's an accounting fact. If we retained capital, then that would be it would look completely different. But we don't. We give all of our profits to the Treasury.
So you were giving profits to the Treasury, now you're not. That has an actual effect. I mean,
Well,
if I was getting $10 and now I'm not, there's an effect.
Well, the Treasury then will have to borrow money that it doesn't get or raise taxes. It'll have to get the money to
Correct.
carry out the spending that Congress authorizes. Yeah. But that's not going to it's not going to affect interest rates and things like that much.
To me, I have the holistic view of our economy where if, in fact, we have fewer dollars coming in, which requires us to raise taxes, that in the end has a real impact on American taxpayers. But thank you.
Reports reported that there's almost $1.5 trillion in commercial mortgages that will come due in the next 2 years, many of them held by small and regional lenders. With property values declining and interest rates rising, these mortgages could be serious liabilities for many banks. Do you think that we may see some banks fail as these mortgages come due? And if so, what can we do ahead of time to prevent that scenario?
So we're spending a lot of time on these issues, and we have been for quite some time. And again, I think you put your finger on it. It's really which banks have high concentrations of real estate, and that is not seen in the large banks. It's seen in some of the smaller banks. So we've identified those banks, and there's a supervisory toolkit where we work with banks to try to help them resolve those issues by raising capital or dealing with what's happening. And of course, what is happening in the office space nationally? There's an issue with people working from home and just less demand. There's a sort of one-time adjustment going on. There are also some other pockets of commercial real estate where there's some softness. So we're working with banks to work our way through this. We're very aware and very focused on the problem.
Well, I'm concerned that it's a ticking time bomb. And let me just say that last week you said that commercial real estate risks are unlikely to pose a systemic risk because the loans are broadly spread and mostly held by smaller banks. But how can we ensure that the potential losses in the commercial real estate don't lead to the draining of assets from smaller and mid-sized banks, and then create further consolidation in the banking sector that brings us back to, I don't want to be back to 2008 when I was here and was asked to do extraordinary things.
We certainly don't want to be there either. And so we're being pretty proactive about reaching out to these institutions and trying to help them get through these significant issues. Again, it's not all smaller banks. It's just some of them have high concentrations in real estate, and it's not in the large banks, which of course was where the problem was in 2008 and 9.
Has troubled me since our hearing yesterday regarding the Basel III endgame proposal that's coming forward by Vice Chair Barr. The proposal is going to have far-reaching ramifications, I think. It's rumored to have over 1,000 pages in it. Yet when I asked Governor Cook about the proposal yesterday, she told me she hadn't seen it, has not reviewed it. My understanding is that the agencies, including the Fed, are due to vote on this on the 18th of July. And given the fact, and I think Senator Warner described it aptly yesterday, the potential for a perfect storm here, if the rumors that we're hearing about capital requirement increases that may be proposed are true, this may come at a time, banks may be preparing for a capital increase at a time when we absolutely need banks to be lending, not constraining lending by raising capital requirements. So I think there are numerous analyses. The impacts on the small business community, on the banking system need to be taken into account. And I'm very concerned, particularly in light of Governor Cook's response that she had not reviewed it, hasn't seen it, and didn't seem to have any perspective on it at this point in time. It's a very short window to undertake a decision on something as complex as we may be talking about with over 1,000 pages in this report.
And it's called the so-called flat Phillips curve, where there just wasn't a connection between how tight the economy is and inflation. That does not appear to be the case right now. I think many people would say that the Phillips curve is now not so flat, and that there is an interaction between.
So that's a yes.
I think that's a yes. Yeah, it's
okay.
This is economics,
And less spending by government is
it means less stimulus, which tends to be disinflationary. Is that fair?
Yes. Yes.
Okay. Let me ask you about the Basel III end game. You know what I'm talking about?
I do.
There's been some reporting, and of course, not every country has to follow the Basel recommendations. The European Union is not following. They're going their own way, and we're kind of going our own way in America, using the Basel directives as a guidepost. But it's been reported that the Fed's going to raise capital requirements by as much as 20%. Or, excuse me, it's going to raise capital requirements to 20%. Is that right?
No, the idea would be to raise them by 20%. In other words, if 20% of whatever current capital requirements are, you would raise it by 20% of the total existing amount.
Okay.
So
if J.P. Morgan's capital requirement right now is, let's say, 13%, it would go to 15%.
Right, something like that. If that were to be what happens.
And this will be for banks $100 billion or more.
No. There isn't a final proposal. So, and I know it's still in motion. I know things are still changing.
Yeah,
so.
but you folks are talking
I've been
about
briefed
it, and
on
you're going to have a lot of input.
No, that's right. So, but I will say, sorry, what was it? Your question was?
Are you going to raise capital requirements for 20% to banks $100 billion or more? Or are you going to affect community banks as well? Smaller?
No, the capital requirements will be very, very skewed to the 8 largest banks, the G-SIBs. There may be some capital increases for the other banks, and there won't. I think none of this should affect banks under $100 billion.
The really big banks you're talking about.
Yes.
Are they the ones that are at risk right now?
They weren't. They were a source of strength in a place of strength.
They're doing pretty well.
Turmoil. Yeah.
We've gone from too big to fail to we're damn happy they're big. I mean, haven't we?
Well, I would say that, as I mentioned, we spent a lot of time and a lot of effort raising the capital standards 10 years ago and more recently, and I supported all of that and was happy to do so. And I think
if they had bought more long-term treasuries, do we think their balance sheet would have been in a better or a worse shape?
They would have had a bigger loss, and more to the point, they would have still had overwhelmingly uninsured deposits.
Exactly.
That were very runnable.
Of course. So I want to sort of the point that I'm making, which I'm sure you can kind of understand here, is that capital requirements are not necessarily a panacea to the type of banking run that we saw in the Silicon Valley Bank case. I think there's a very good argument that higher capital requirements on Silicon Valley Bank would have made the bank run worse, or even could have made it a more catastrophic or an even quicker failure. And at the very least, I don't think they would have helped. Do you agree with that?
I think there's a lot to unpack with Silicon Valley Bank.
Of course.
And the thing is, remember, it was a capital issue. They were trying to raise capital. That was what was going on, and the market was very focused on their portfolio losses, which were highlighted by the fact that they tried to raise capital, and so there was a capital issue there. Now, you're right. If you had filled the capital hole but you have to retain earnings or raise it or get some new equity. And if you just use that to buy treasuries, then yeah, it wouldn't have made things better.
Yeah, appreciate that.
Passed Dodd-Frank to make banking regulations tougher and to avoid future bank collapses. And very soon after that, bank CEOs started lobbying for weaker rules. Now, Chair Powell, you also lobbied for weaker rules. When President Trump first nominated you as Fed chair in 2017, you testified, actually in this very room, I think, that you intended to, quote, consider appropriate ways to ease regulatory burdens for the banks. And when I asked you if there were any rules at all, that you thought ought to be made stronger, do you remember what you said?
I think I pointed to the net stable funding ratio.
No, actually, that's not what you said. You said, honestly, Senator, I think they're tough enough. you couldn't point to anything you thought should be tougher. In 2018,
in the event we strengthen the net stable funding ratio.
In 2018, you supported Congress's weakening of those rules. You led the Fed in hacking away at one rule after another. According to the Fed's own analysis of the Silicon Valley Bank failure, you weakened the rules in multiple ways. You reduced capital requirements. You weakened liquidity risk management. You skipped out on using enhanced stress testing for banks with tens of billions of dollars in assets and more. And the result was that the second, third, and fourth largest bank failures in U.S. history, which together required $23 billion in bailout money. In fact, you now hold the record. In a single year, the FDIC has been forced to rescue more giant failed banks on your watch than any Fed chair in American history. Chair Powell, do you agree with Vice Chair Barr's conclusion that the Fed bears a big share of the responsibility for the failure of SVB?
I certainly think that our supervision has been shown to have been lax in not being assertive enough. I think that the supervisors saw the right issues but weren't forceful enough in hindsight. And I think that's certainly a fair conclusion.
Okay. So those regulations were weakened. Those supervisors were clearly asleep at the switch for more than 5 years under your watch. And I'll just say it again. This is exactly why I opposed your nomination in 2017. The decisions that you made, the votes that you took, and the things that you said helped caused this mess. And when you were up for reappointment in 2021, I opposed your confirmation because I believed that your continued leadership would be dangerous to our financial system. And the Fed's own report confirms that. So yesterday, Chair Powell, this committee voted on a bill to help hold CEOs accountable when their actions blow up banks. At the Fed, you are the one who lobbied, who drafted, and who voted for weaker rules, and you were ultimately responsible for the team of Fed supervisors who fell down on the job. Do you take responsibility for your role in these bank failures?
So I think we learned some lessons from the bank failures, and the main responsibility I take is to learn the right lessons from this and to undertake to address them, so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system. That's not supposed to happen, and we need to take appropriate steps to make sure it doesn't happen again.
So I just want to make sure I understand what you mean when you say you take responsibility. Do you take responsibility for your actions that led to the failures of these banks?
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you
Actually,
in charge
under the law, the vice chair for supervision has
Okay, so you
has
take
sole
no
authority.
responsibility
I didn't
on
say
it.
that.
Well, that's what I'm trying to ask.
That's
I'm trying to
not what I said.
understand what you take responsibility
I
for.
take responsibility for addressing the situation appropriately.
That's talking about
that's
going
my
forward.
Focus. That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past. You know, a month ago, we had the CEOs of the banks that exploded in here. And each of them had scooped up huge bonuses, and each of them said they plan to keep every penny of that money. And now we have the chair of the Federal Reserve who led the charge to weaken bank regulations, who oversaw the bank supervisors who failed miserably to hold these banks in line. And again, the accountability is zero.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we have Jerome in the house in front of the Senate. And again, guys, he doesn't tell us the truth. That's how we know the main event is right around the corner. Now, he states that the reverse repo started shrinking in March. And guys, we know just slightly. And we know the debt ceiling didn't get complete until June. And we're still seeing the reverse repo hover around $2 trillion. And you clearly heard Jerome Powell state that Janet Yellen is going to use the reverse repo to replenish the accounts. Now, Basel III just keeps coming up. And guys, we know now it's all about liquidity. But what they're not telling you is that it's for the fourth industrial revolution. Guys, if you're going to have Fed now, if you're going to have real-time settlement, you have to have plenty of liquidity. And we know this banking crisis was planned 10 years ago, so therefore they can get rid of these small banks and only the big banks are left. And we know the banking crisis is not over. We have commercial real estate, we have mortgages, and then we know there's going to be mass layoffs coming because credit is going to start shrinking. And we also had Elizabeth Warren grilling Jerome Powell. And guys, we know that's all the Hegelian dialectic, all acting. And we know Jerome Powell stated he wasn't worried about inflation. Janet Yellen not worried about inflation. Guys, we know all this money printing caused the inflation, but you have to go back to the beginning. We know the NWO caused the problem, wait for the reaction, and run in with the solution. The C word allowed them to print all this money, bring in all this technology while the masses are distracted, getting free money, going shopping. And now all that money printing caused all this inflation. Now they're going to be raising rates and fighting inflation that they caused, which we know high rates for longer will destroy the global economy. Remember, the central banks are moving in lockstep, raising rates and running off the balance sheet in order to land us in the fourth industrial revolution. And while the masses are being laid off, we know they're going to run to the government. And the government already has the solution. That free money airdrop to them, that programmable money, telling them what, where, and when and how to buy, and they have 3 to 6 months to spend it or poof, it's gone. And that free money is the carrot in order to get the millennials and Generation Z inside the metaverse. And remember, the crypto teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
I actually believe this technology is going to be very important. Look at it. We have been part of the huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Crypto Teacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.